Hey everyone, me Kevin here. In this video, I'd like to discuss a warning that Raphael Bostic of the Federal Reserve just provided, and it's something that, let's just say, even Mr. Bostic was caught blindsided by. Take a look at this. This is a little bit of background on Mr. Bostic. Back in January of 2022, in a Wall Street Pro central banking piece, the Wall Street Journal broke down that Mr. Bostic added that he expects some moderation in price pressures, noting as we move further into the year, we'll start seeing some of those inflationary pressures abate, which will allow us to not be so dramatic in our policy actions. Right. But that's exactly the opposite of what happened. Instead, in 2022, because of the persistence and the extremeness of inflation, we actually saw interest rates rise at the fastest level that we have seen since the 1980s, and we rose from a 0% level all the way to 4% in the span of just 9 months. 400 basis points in the span of 9 months is one of the fastest rates we've actually seen interest rates, the rate of the rates, go up in history. It's pretty remarkable. There were only brief periods in the 1980s where we briefly skyrocketed past that sort of rate of an increase, but that was also followed by rapid cuts in the early 80s. So, Mr. Bostic, also in the 2021-2022 cycle, suggested the following. At the beginning of the pandemic, when we asked business leaders how long do they think this would last, they told me 5 or 6 months and we'd be good. Now, we're at the beginning of 2 years in and we're still not good. It's just going to take longer than I'd like. Of course, I'd love this to be done now, but we've got to have to show some patience and some perseverance. Everything is just taking longer than I would have expected going in. Okay, so we've seen a Bostic go into the pandemic thinking, okay, we'll have some inflation, it'll be transitory. That was some of the information that even Joe Biden echoed on national TV. Hey, we'll have a bump on inflation, it'll come down. A lot of that is informed by his economists. Well, everyone was wrong. In fact, inflation wasn't just a little bump. It was a massive explosion of inflation. Now, of course, inflation has come down substantially since then, but this mindset of Bostic suggesting everything's just going to take longer to normalize is slightly problematic. And there's a second reason why it's slightly problematic that we need to set some context for. So first, I wanted to give you a little background on Bostic. Then I want to give you a little background on the Fed. Then I want to reveal to you what Bostic just said and what the early warning is. So stay tuned for that. But first, this second bit of fact building. Notice that when the Federal Reserve cuts rates, it is extremely rare that rates are cut slowly. The only time we can really point to rates being cut slowly was right here in 95, where we kind of stabilized around 5 for about 3 years. We started cutting rates in April of 95, and by about August of 98, that's when we saw a little bit more of a reduction in rates. Of course, that unfortunately culminated in the dot-com recession. Rates actually started rising again before we got below 4.5%. So there wasn't actually a lot of a return to norm. In fact, it's very rare that we see sort of a large decline in rates without a recession. We did have a period of time in the mid-80s where we did see that. I mean, we went from maybe this normalized level over here, around 8.5%, down to about 5.5%, but certainly nowhere near recessionary kind of levels of cuts. Usually, rapid cuts come from recession. Rapid cuts, rapid cuts, rapid cuts, rapid cuts, rapid cuts, rapid cuts. As you can see, they're almost always aligned with the gray bars, a recession. Same thing over here in the early 90s, rapid cuts, dot-com, rapid cuts, the financial crisis, rapid cuts, and of course, COVID, rapid cuts. So usually, reducing the policy rate is a tool that can be fine-tuned like it was over here in the mid-90s or in the mid-80s, maybe even you could say the 77 era, but it either culminates in a large rise in interest rates or a recession where interest rates plummet. So, the history of the Fed tells us that usually, even if we start seeing rates come down, they're probably not going to plummet unless we get a recession. If anything, if there is no recession, they're actually more likely to go up again. Look at that. The times we have had no recession, here, rates came down, they went up again. Rates came down after the recession, went up again. Rates came down, went up again before the recession, down, went up again. Notice you tend to see rates go up before you see them go down in the absence of a recession. So that's important to know, as well as Bostic suggesting that more time is really needed to get through what the pandemic has done. Everything is taking a lot longer. I agree with this, by the way. I'm going to give you my anecdote, and I want to give you the news on what Bostic just said. Patience is so wildly understated in today's economy because I feel like we're all still used to what happened in the pandemic. There was a panic for 30 days. Massive trillions of dollars of stimulus money came in, and we had a V-shaped recovery. We had the Larry Kudlow V-shaped recovery. Everything was so fast. We went from shut down the world, everything's a disaster, shut down flights, shut down vacation, shut down everything, to how fast can we reopen, how fast can we reinvest in all these businesses, how fast can we get back to normal. Which is good. We want things to go back to normal. But this interest rate path of the Fed might be something that we desire to go back to normal very quickly, and then we can argue, of course, what normal is. But we might have to be much more patient for. Quick tangent, what is normal? Well, some people would say that the long-term normal is actually a rate around 5%. And what they do is they try to draw an average here, and they basically argue, well, if we draw a bar across this, the average long-term rate should probably be somewhere in this gray bar, somewhere around 5%. But that's using the mid-80s in the average. I actually think that's disappropriate. It's inappropriate. I think the longer run trend of inflation is down thanks to the nature of capitalism. But in the shorter term, it's probably going to take a lot longer for those longer 10-year, 20, 30-year trends to actually show up again. So I don't think we're ready for massive cuts, within this year or maybe even next year or maybe even the year after that. We might not actually see the rates that we used to see until the early 2030s, which is kind of scary because I feel like we're just in the early 2020s now. So that's a decade away. Jack is 8, he'll be 18, and he can leave the house before rates might be back to normal, which is really weird to think about. But what did Bostic just tell us? I'm going to read it to you, and I'm going to add some commentary here. I want to be clear that right now I don't have any short-term trades going, so my goal is just to provide unbiased information. And I understand that I went into this cycle thinking inflation was going to fall a lot faster than it did, and I recognize that was wrong. Everything is taking a lot longer to decline. I do wholly believe that in the very long term, the neutral rate of interest will be lower. Long-term interest rates will be lower than they've ever been before, and it's not actually going to help everybody. It's actually going to be bad news. It's going to widen the wealth gap even more. Those people who are exposed to investing in real estate or maybe even real estate startups, or those of you who are 1031ing into what we're doing, where you can 1031 essentially into a real estate security, which is wild that you can do that. Tax deferred. Email us at ir@househack.com if you have questions on that. Those are a very exciting things for people who have money, but they're not useful for people who don't have money. And I think in the long term, very low interest rates are going to widen the wealth gap, and high interest rates right now are going to make it very difficult to start buying assets. So you're kind of screwed now and you're screwed then. When interest rates come down, everybody else has already bought up the assets and asset prices will be too expensive. When interest rates are high, you're suffering with too much debt. It's really, really challenging to get on the ride of building your wealth right now. It is devastating because it's going to worsen the wealth gap. So, we'll talk practically maybe about what to do in just a moment, but first, what did Bostic just tell us? Federal Reserve Bank, Bostic, the bank president of Atlanta, Bostic says he now projects just one interest rate cut this year, adding that a reduction will likely happen later in the year than he previously expected. So in other words, he thinks we're only going to get one rate cut, and it's going to come late in the year. That could be September, that could be November, that could be December. Bostic has previously said that it would be appropriate for the Fed to lower rates twice in 2024, with the first of those rate cuts likely coming in the summer. It was a close call. We will have to see how the data comes in over the next several weeks. The Atlanta Fed chair said that he is less confident on the trajectory of inflation than he was in December, noting that some troubling things underneath the headline figures are occurring. He pointed specifically to the breadth of some items in the consumer basket that are rising at an elevated level. The key gauge of underlying inflation topped expectations for a second month in February, and the Fed's preferred inflation data, expected to be released next week, is anticipated to show still elevated pricing levels. What they're referring to is the PCE. PCE is expected to come in next week. We'll be covering that live, of course, on the Stock Market Open live stream. And right now we're looking at a core PCE deflator month over month of 0.3 and a headline month over month of 0.4. Both of those still higher than the Fed's projected, given that 0.3 on a month over month core is 3.6% of inflationary pressure on an annualized basis, and 0.4 is 4.8% on a headline level. It's not great. Fed officials held interest rates steady for a fifth consecutive. Okay, we know this is a little bit of a background here. He mentions the economy continues to deliver surprises and it continues to be more resilient and more energized than I had forecasted or projected, Bostic said. So as a consequence, I sort of recalibrated when I think it's appropriate to move. Given that the economy is doing well, that gives us space for patience, he said, and we should just be patient. Well, so now we need to reconcile this, and then I want to talk about, like, what do you do? So how do you reconcile? Well, first of all, remember, the Federal Reserve, historically, unless we argue this time is different, history tells us the Federal Reserve has a bias to move interest rates up absent a recession, not down. You really only get a rapid down in a recession, or maybe this soft landing of the mid-90s, but it wasn't much of a down. There's a reason for that, and it has to do with the fact that rapid rate cuts usually only occur as sort of an emergency lever. When there's panic, they pull the lever of emergency rate cuts and plummet interest rates. Slight reductions in interest rate, little adjustments like we saw in the mid-80s and the mid-90s, those really aren't going to bring rates back to where they were. So, practically, what does this mean? Well, while the Fed will recalibrate and try to tell us everything is just fine, even though prices are going to stay higher, the prices aren't going to come down, inflation will slowly moderate, their goal is to keep the economy going, we have to live with this reality for probably much longer than we thought. It's a reality of much higher rates for a lot longer. And so there are some benefits and some pains that come with that. One of the pains that comes with that is it makes it harder to acquire assets. It makes stocks and real estate more expensive to get into. We always talk in my courses on building your wealth, link down below. We always talk about how it's important to own assets and businesses. But starting a business, getting a real estate loan, getting into stocks is harder when things are more expensive. So what is usually the MO during a higher interest rate period? Well, usually the MO is you work really hard, you make more money at your job, you utilize high savings rates, and you do your best to try to get into assets. Or you save as much as possible. So that way, when the Fed actually pulls the lever again, whenever that will be, you have cash to deploy at the time that might be best. Now, timing the market is very difficult, so it's usually not for everyone. And this is why I'm a big fan of, as you are capable, average into real estate, especially single-family real estate. The way I talk about, get yourself a wedge deal. That's what we do with househack. The wedge insulates you. Even if the market falls 20%, you're insulated if you get a 20% wedge on a good deal. So that's why it's so important to insulate yourself. My longer-term concern, though, is that these higher rates will actually just make a lot of people wait to buy assets at all. They won't consider the wedge. They'll just wait to buy assets. And then as rates fall, asset prices potentially just go up even more. See, I'm not saying in a recession prices will be lower. Rates might be lower. It doesn't necessarily mean nominal prices might be lower. Because sure, you might be able to go buy a house at a 1 or 2% 30-year mortgage rate. But if we have mortgage rates that low, are home prices going to be even more unaffordable? Or if homes become less affordable, is that only because we have a lot of joblessness? And then if we have a lot of joblessness, that could include us, which means now we can't qualify for a loan anyway, even though the rates are cheaper. So everybody is kind of stuck between a rock and a hard place. And so we have to look at this new reality, which is rates are probably going to stay high for the rest of the decade. And if rates stay high for the rest of the decade, over 3-4%, I understand, again, people think that's the long-term average anyway. I don't think so, but we could debate about that in a different video. I think the long-term trend is actually lower than where we were before the pandemic, but that's just my opinion. But again, I think by the time we get there, asset prices will be even more unattainable. So I'm not here saying YOLO all in. I'm saying do whatever we can in a mass basis to build businesses, build your income, work hard, get into good deals, good assets, whether those are good deals on businesses, partnerships, stocks that are going down in value when there's an opportunity to buy them. But be careful, stocks obviously should just be one portion of your portfolio, or real estate and buying wedge deals. I think that's the opportunity. But unfortunately, betting on rates plummeting anytime soon, I don't think that's in the near-term future unless there's some form of crazy black swan event. I don't see it just yet. But then again, that's the nature of a black swan. Anyway, hopefully this is somewhat insightful. If you found it useful, consider sharing it. Good luck, everybody. If you like what I share, make sure to subscribe to the channel, share the video, and we'll see you soon. Goodbye.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than househack, nor am I presently acting as a market maker. Make sure if you're considering investing in househack to always read the PPM at househack.com.